Did you know major banks have suddenly closed, leaving countless Americans without access to their money? This unexpected shutdown has jolted the financial landscape, causing widespread concern and uncertainty among individuals and businesses. The unprecedented action worsens an already fragile economic situation, sending shockwaves through the system. The reports surfacing from reputable sources like The New York Times have brought to light an alarming pattern of banks unexpectedly shutting down personal accounts. This unsettling trend, ostensibly carried out to mitigate potential financial risks, has unleashed severe consequences on countless account holders. The absence of any forewarning or notification has left individuals abruptly disconnected from their financial lifelines. This unforeseen action has triggered widespread distress and upheaval among those affected. This abrupt closure of bank accounts has blindsided many, plunging them into an abyss of uncertainty and financial turmoil. For those impacted, the sudden loss of access to their funds has disrupted their financial stability and sent shockwaves through their daily lives. The lack of prior notice or explanation from the banks has exacerbated the distress, leaving individuals grappling with the sudden and unexpected loss of their financial resources. The repercussions of these closures extend far beyond mere inconvenience. They've disrupted the lives of individuals who relied on these accounts for their everyday needs. People find themselves in a state of confusion and helplessness, unsure of how to navigate this sudden and unforeseen turn of events. The absence of clarity or guidance from the banks has exacerbated the already challenging situation, adding further strain to the affected individuals. The gravity of this situation cannot be overstated. The sudden closure of bank accounts without prior warning or explanation has not only created financial havoc, but also eroded trust in the banking system. The lack of transparency and accountability in this process has sown seeds of uncertainty and fear among account holders, who now grapple with the aftermath of being abruptly cut off from their financial resources. This unforeseen crisis calls for a deeper examination of banking practices and regulations to prevent such distressing occurrences in the future. Amidst a climate of escalating economic concerns, the abrupt closure of bank accounts has intensified existing anxieties about financial stability. Recent studies have painted a disconcerting portrait of the financial landscape for American households. Shockingly, a substantial 36% of citizens find themselves devoid of any savings, while a significant 65% face the uphill challenge of escalating household expenses without a corresponding increase in income. This glaring disparity between rising expenses and stagnant income has thrust many individuals into a precarious state of financial vulnerability. The fallout from these unforeseen bank closures arrives at a time when financial worries are already prevalent among a considerable portion of the population. The abrupt severance of access to funds amplifies these concerns, exacerbating the prevailing economic anxiety. Families and individuals, already stretched thin financially, now grapple with the added burden of navigating their daily lives without the resources they relied upon. Moreover, the absence of savings and the alarming disparity between expenses and income levels leave many individuals on the brink of financial instability. The sudden loss of access to their funds further compounds this vulnerability, leaving them scrambling to find alternative solutions to meet their financial obligations and everyday expenses. The resultant anxiety and uncertainty cast a dark shadow over the future financial prospects of those affected. This distressing scenario highlights the urgent need for broader systemic changes to address the fundamental disparities in financial security. It underscores the necessity for proactive measures to bolster financial literacy, promote savings initiatives, and implement policies that safeguard individuals from such abrupt financial shocks. The current predicament serves as a stark reminder of the fragility of financial stability and the pressing need for comprehensive measures to address and mitigate these vulnerabilities. The repercussions of these bank closures extend beyond individual account holders. Small businesses, the backbone of the economy, have been hit hard. The abrupt termination of business accounts has left many struggling to meet payroll and fulfill their financial obligations to vendors. The repercussions of such actions are not just financial. They tarnish trust, disrupt operations, and pose an existential threat to these enterprises. While banks cite risk reduction as the rationale behind these closures, the consequences are harsh and unjustifiable. Accounts flagged through suspicious activity reports become targets, leading to abrupt terminations, disregarding the human toll these decisions inflict. This impersonal approach, driven purely by numbers and risk mitigation, fails to acknowledge the real-life impact on individuals. From a single parent running a small business to delinquent customers facing account closures, the tightening of lending standards has compounded the financial woes. As banks tighten their purse strings, access to credit becomes increasingly challenging. This credit crunch affects not only struggling consumers, but also businesses seeking vital financial support. With pandemic aid dwindling and inflationary pressures mounting, the inability to access credit exacerbates the financial strain on both households and businesses. The domino effect of tightened lending standards, reduced access to credit, and the sudden closure of accounts portends an ominous economic future. Economists and experts fear that these collective factors could thrust the economy into a recessionary spiral. Higher interest rates and an impending wave of defaults on commercial real estate loans further compound the risk of a looming economic downturn. The repercussions of these bank closures are not confined to individual account holders or small businesses. They reverberate throughout the financial markets. Banks, grappling with consecutive quarterly drops in deposits, face substantial challenges. This unsettling trend has prompted concerns about banks' financial stability, reflected in their declining stock performance and marked losses in their treasury bond portfolios. To comprehend the depth of this crisis, one must examine its roots. The prevailing credit cycle, characterized by easy credit and loose monetary policies, has been a significant contributing factor. The Federal Reserve's aggressive quantitative easing measures and historically low interest rates fostered an environment of reckless lending, fostering complacency in the financial system. However, this period of easy money abruptly ended as inflation surged to its highest levels in 4 decades. The Federal Reserve swiftly transitioned from flooding the market with liquidity to tightening monetary policies, raising interest rates and reducing market liquidity. Consequently, banks found themselves caught in a precarious situation, grappling with the repercussions of past reckless lending practices and abrupt policy shifts. Amidst this financial turmoil, another looming threat arises from the commercial real estate sector. With office occupancy rates at record lows and remote work becoming prevalent, the viability of commercial properties is increasingly uncertain. This scenario raises concerns about the potential default on commercial real estate loans, adding another layer of risk to banks' balance sheets. The closure of numerous banks, notably Citizens Bank among others, in a relatively short period has sparked intense scrutiny regarding the effectiveness of regulatory oversight within the financial sector. The rapid succession of bank failures has not only raised eyebrows, but has also heightened concerns about the stability and reliability of the current financial system. This sequence of closures occurring with unexpected frequency points to potential inadequacies or loopholes in the existing regulatory framework. The ramifications of these closures extend far beyond the financial realm, impacting lives, livelihoods, and the broader economy. As the situation continues to evolve, there's an urgent need for proactive measures, prudent financial policies, and enhanced regulatory oversight to mitigate the impending risks and restore stability to the financial landscape. We hope you enjoyed this video, and if you did, please don't forget to like, share, and subscribe to our channel.